around the globe, best opportunities for 2023 and 2024. I'm excited about this panel. Our moderator is going to be Julie Cooling, founder and CEO of RIA Database and RIA Channel.
Hi. Meet you yet? Hi. Nice to meet you. Hi, I'm Julie Cooling. So I thought I'd take a 2-minute opportunity to tell you a little bit about RIA Database and RIA Channel, since this morning's conversation was a lot about distribution. So I'm the founder and CEO of both RIA Database and RIA Channel, and started the firms 17 years ago. And we work with many of the folks in the audience, so it's nice to see a lot of colleagues and friends. And we focus primarily on digital distribution. So we are doing cap intro every day. We do investment webcasts, learning management systems, and content distribution. And of course, we run the RIA Database. So we're profiling financial advisors and help folks like you on the distribution side. So I'm happy to be here with my peers and colleagues today, and I'll turn it over to you to introduce yourselves, please.
Thank you, Julie, and good afternoon, everybody. My name is Kieran Kerwin. I'm a director of investment strategy with ProShares. ProShares is a top 10 ETF provider. We manage roughly $60 billion in assets. Many of you who know ProShares may know us for our geared fund business, so our leveraged and inverse funds, which we are market leaders in. We also have a large and growing strategic fund business for buy and hold products, and also most recently have introduced a number of crypto-related products. So great to be here, and we've done a number of events with Julie and RIA Database, so if you're looking for some of our message through those means,
Thank you.
please do so.
My name is Chris Brown. I am the CIO of Democracy Investments. Quick shout out to all the organizers and sponsors of this conference. Thank you very much. Without it, I would have been stuck on the Bay Bridge today at what my fellow egotists would agree is the second most important conference going on here in the United States. So thank you very much for that. Cheers. We have an exclusive license with The Economist to use their Democracy Index, and our flagship product is an ACWI ex-US tilt using it. So we tilt away from authoritarian countries and towards more democratic ones. We launched in 2021 in the beginning of the second quarter, and we've got roughly 400 to 500 basis points, depending upon which market cap product you want to look at, of outperformance.
Matt Tuttle from Tuttle Capital. We're a little bit different. I'm a trader at heart, so I like to launch ETFs that A, I want to trade, B, I think other people are going to want, and C, if we can launch something to kind of take on an issue that pisses me off, I like doing that as well.
I'm Alex Morris from FM Investments. Like Matt, I'm a recovering rates and swaps trader. FM recently launched the U.S. benchmark series, so T-bill, U2, U10, first true single security, single treasury ETFs. Shockingly for someone who's a rates trader, to provide folks direct access to rates in a very ETF-friendly, easy-to-trade way.
Fantastic. So this is the best ideas panel, and opportunities, trends, themes, what you're seeing, and maybe some trade ideas. So Matt, let's start with you.
Sure. So in stuff like this, I usually would prefer not to talk my own book, but because I launch stuff that I want to buy myself, that sometimes gets difficult. What I'm kind of seeing is a lot of opportunity in, for lack of a better way to describe it, the personal security space. So we recently filed for an ETF that probably is going to be a January launch, ticker symbol GUNZ, G-U-N-Z. And the idea in that space is I think you're going to see a couple of things. Number one, I think you're going to see individuals becoming more and more responsible for their own safety. Number two, I think regardless of who gets elected, you're going to see somewhat of a, let's say, pushback on what's going on in the border. And I think you're going to see somewhat of a pushback on what's going on with crime. And so, I think you're going to see money starting to flow into guns, home alarms, mace, tasers, correctional facilities, things of that nature. What's interesting is, and typically I don't like to do index funds. I always thought index funds were kind of stupid. But this is going to be an index because it should be. If you look back over the past 10 years, the index of these companies has more than doubled the return of the market. But the past 3 years, it's woefully underperformed. And some of that is because there's no Magnificent Seven in the personal security space, but also some of it has been policy, where if you start to see some of that reversed, I really do think that this is going to be an area. And if you're looking for specific trade ideas, so there's 2 companies in the space that I trade personally and try to buy the dips, and that's CXW and GEO. Both in the prison space, but also GEO makes some monitoring systems for migrants. So I think that is a space you really want to look at going into 2024.
Great, and I'll ask Chris.
So basically from I'll talk my book, I guess. We look at Europe as being cheap. It's trading, or international as being cheap. There's a lot of home bias. It's trading at roughly a 12 forward-looking PE handle. Equal-weighted S&P is at a 15, 16 handle, and market cap is at an 18, 19 handle. So you're getting a pretty significant discount over in Europe. Is some of that discount justified? Absolutely. But I'd sell you on international. I'd sell you on international first before selling you on our particular strategy. And all I can say is we have seen this movie play out from 1946 to 1989. I was a big guy believing in the whole globalization thing. This is now sort of, we saw it retreating. It's going to continue to retreat. And this is a relatively simple tilt that encompasses that, whether you want to look at it as G20 versus BRICS or any of these other things that you've heard earlier about, friend-shoring or close-shoring and redesigning of supply chains. And this is just a very simple way of capturing that. There's roughly $1 trillion in the U.S. indexed to the ACWI. And so I like to say, come for the alpha, stay for the weapon, because if we get real traction, then you start diverting real capital flows.
Can I just ask specifically within your strategy, do you short countries?
We do not short countries within this strategy. It's an underweight. So for example, People's Republic of China is downweighted by about 70%, 72% relative to the market cap.
Great. And Kieran?
So part of our strategic fund lineup at ProShares is that we run the largest lineup of dividend growth ETFs. We are big believers in not just companies that pay dividends, but grow them. If you look at the evidence over time and you break the markets into dividend-paying policies, what we found, and this is across asset classes, by the way, we found that companies that grow their dividends over time have been the outperformers. They tend to be amongst the highest quality stocks in the marketplace. Dividends have been out of favor, especially in this type of year. The lower quality, higher dividend yielders out there, if you're relying on high dividend yielding strategies for your income, you've probably been disappointed this year. Where we see an opportunity from a dividend perspective is in a place that you may not naturally associate with dividends, and that is technology. So if you look at what's going on in the dividend space and you marry that with technology, that's where the growth is coming from. There's, of course, a whole lot to like about the technology space. You go back to 2011, Mark Andreessen, right, wrote that famous quote, software is going to eat the world. And largely that has borne true. The earlier panel up here talking about how artificial intelligence is going to transform not just our lives, but increasingly our industry. So if you believe in technology, and if you believe that as growth has been slowing, one of the few areas to look for growth going forward, at least in 2024, if you believe the analysts, is of course the tech sector. The tech sector offers also the highest level of margins relative to any other sector in the marketplace. And as we see it, it's one of the largest sources of dividends in the market. So people think dividends, they're probably thinking something like financials, the banks, healthcare stocks, staple stocks, but increasingly now the tech sector, because they're returning so much capital back to shareholders, not just in the form of buybacks, but in the form of dividends, it's now the second largest source of dividends in the marketplace. Now, the flip side to the technology story is that there are a few things not to like from a fundamental perspective. Number one, technology is rather concentrated. We all know that in the S&P 500. Even within the tech sector, if you take a market cap weighted approach to technology, roughly 60% of your exposure is going to be in 3 or 4 stocks. That typically, when we've seen that disparity, has not ended well. So what we did a number of years ago is back in 2019, we launched a technology aristocrat strategy. We look to own only the technology companies that have grown their dividends over a period of 7 consecutive years. That's an equally weighted strategy, and it also happens to trade at around the same forward multiple as the S&P 500. So if you like tech for all of its growth and all of its fundamental positions in our portfolio, but don't like the fact that it's trading at over a 30 times multiple, taking a higher quality, equal weighted approach in what we call the technology dividend aristocrats, TDV is the product that we support for that strategy. From our perspective, makes a lot of sense in this type of environment.
Great. And Alex?
I don't know how you follow financial engineering on AI, global politics, and guns. Here in the graveyard shift, and I'm going to talk to you about bonds, which forgive you if you leave now. But sort of at the highest level, if we look at the ETF space, about a $10 trillion industry, which is stats you will have heard several times today. About 70% of that is in equity ETFs, 20% in fixed income ETFs, not all of it traditional bonds, and 10% in ETPs, ETNs, and other products. But bonds are a tremendous part of everyone's allocation and a much larger portion of the actual economy and investable asset base. And they're underrepresented in ETFs, and the indices are largely dominated by old traditional indices that are almost, in some cases, like AGG is a great product, but the underlying index is an imprecise tool that is so large that we acknowledge it's uninvestable. We know that because we build a version of the AG called the investable AG, which itself is also uninvestable at this point. So we look at this relatively small portion of the ETF space and see that that's a great opportunity to invent new products, to be more creative, to provide more precision in an area where precision has often lacked, and where trading the underlyings is hard. It's pretty easy for everyone to go and buy a series of, whether they're ETFs or equities. We've made that simple. Robinhood proved you can turn that into a game on your phone. It's a lot different when you have to memorize a CUSIP, enter it, try to think of yield and price, do bond math, which I know just sent shivers down many spines. And we think there's a way to really fix that. We launched single treasury ETFs. When we did that, folks wondered, well, I can buy a treasury. And our answer was, try. And many folks came back and said, I went to treasurydirect.gov. It didn't work. I got there. I typed in 2-year treasury. It gave me 2,000 options. Which one did I want to pick? And the benchmark series, now about 15 months old, is raised about just short of $4 billion. And that kind of got the innovation engine for us thinking, what have we done as institutional fixed income managers and rates traders and other things that have been on those bits of the portfolios, generally locked up to SMAs or to actively manage products, that we know there's a better way to deliver that beta. And so that's where we've spending a lot of time. We filed recently to do the same thing in the investment grade credit space, and we'll keep tackling increasingly other parts of the fixed income universe because we know there's demand for it. We've been frustrated investors in some products. They may be great products, but they follow indices that are just not good enough by modern standards. So we've been working with index providers to help deliver more content that's helpful, and then ultimately we'll fall on with more products. And again, probably the most exciting asset class of all, bonds. But this year, finally, folks started to take interest, right? For a long while, it was choose your flavor of zero. Yields were immaterial, and now all of a sudden, yields are back. Didn't take us long as investors to get used to a 5 handle on a T-bill. And now that the curve has kind of come back down and settled around 4.5, folks already have this fear of, did I miss the whole trade? And oh my God, 4.5% isn't good enough. But if we go back 2 years, 0 was just fine, thank you. So a lot more to come there. A lot of exciting things I think that'll happen in credit in general as folks take a broader interest. And a lot of firms from institutions, and some of the largest institutions are investors of ours who can do this. They have the infrastructure, but they find that they would rather articulate their positions through ETFs or things that are easier for them to manage than be obligated to run large shops. And we're going to continue to provide products for those users and for individual investors who want to buy bonds but just frankly don't know how or are afraid to.
Great. So from a macroeconomic standpoint, the world's kind of a mess, right? And it wouldn't be inappropriate for us to talk a little bit about that and how maybe you're hearing from advisors and positioning portfolios and needs and concerns. So Matt, to you.
Yeah, so, I think a lot of the economic stuff and FOMC stuff we've seen over the last couple of weeks basically means what we all kind of know, that the Fed's done. Eventually the question will be, when are they going to start lowering rates? What is the neutral rate once, and how long is that all going to take? Right now, I don't think that matters. I think you're going to see a rally into year end. I think there's an ungodly amount of active managers who are woefully underperforming whatever index that they're measured against, unless their entire portfolio was a magnificent 7, which it probably wasn't. So those guys are going to have to try to figure out some way that they can justify their fee, and they're going to be buying hand over fist. So, and I'm not talking to advisors, I'm talking to retail guys all day. So, I'm hooked into 4 Discords and Twitter, and, and these guys are excited. We're back is all over the place. And these guys are making money hand over fist, and, and it's back to a bull market again. I think it'll all, eventually might not end so well. But, one area also that I would focus on more from a trading perspective, and again, I hate talking my own book, but I love the idea, is looking at shorting regional banks. So you've had, interest rates go up very far, very fast. You've seen some regional banks go under. There's got to be some more that have some issues. And at some point, you're going to see those guys going under. So from a trading perspective, one thing I'm talking to the retail guys about is, every time you see a pop in regional banks, shorting them. So we're going to have a product, 2X inverse regional bank, December 12th. And again, it's really because, I've been shorting regional banks all year. It's been great. But individual regional banks can sometimes be a pain in the ass. You might not be able to find borrow. The option chain isn't liquid. So, this will be a way to do it. And again, if you're looking for one name in particular, symbol AX, every time that thing pops, short it.
And while you're talking, Matt, if you don't mind, also, I know you launched single stock ETFs. Can you talk about how popular they've been and how folks are using them? Yeah,
so we just launched the first ever 2X long short Tesla and 2X long short NVIDIA. And again, stuff I want to trade. Options on 2X products are a lot of fun. The retail degenerates that I talk to all day love options on 2X products, and they like, 2X products as well. There are a bunch of other Tesla products out there, but, like I tell everyone who asks, 6-minute abs are better than 7-minute abs. And we've started to see flows the way you would expect. 2X long Tesla has gone from 0 to, I mean, Tesla was down today, so I don't know, but around 20 million in less than a month, which has been pretty cool. I think in the whole complex, we're at about 30 million and, getting a lot of volume every day, a lot of interest from the retail guys. And it's about what you would expect. You look across the spectrum and, ProShares probably has the same deal. The more leverage, the more people are interested on the retail side. I don't know about the advisors, but retail degenerates love leverage.
Alex, I'll have you go next. Thanks.
I guess we see some retail interest, but leverage for us is duration. And so we've seen a sudden shift in duration. I think most of the conversations we've had recently are folks, particularly in the advisory level, saying, thank God we can actually show our value again. What a well-organized, rebalanced, globally diversified portfolio can do. And there's a lot of Fed speak and all this other stuff that folks try to decompose. When advisors talk about that, we show a picture of us sitting on the roof of our building in D.C., where with my binoculars I can actually physically watch the Fed itself. And we point out to them that's about as useful as reading all of the materials afterwards, because by the time they can trade it, it's too late. It's been arbed out by the market. And that to sort of move away from that noise. And we've seen sort of a response to that. But I think advisors in particular can put aside the noise of government shutdown that was obviously going to be averted, it was, and focus on actually helping folks generate a return, which they can do. For 5 years, if you're an advisor, you had to justify why your clients just didn't buy SPY and go home. And in many respects, that might have been a better trade. And advisors in particular who like to trade, I think have now found they can actually add value, which is probably a welcome sigh of relief from just purely offering financial planning and related services. But I expect that to continue. The downside is some advisors are going to find out they're not as good at this as they thought they were, as they remember themselves being. And ultimately, clients will be the adjudicators of that.
And Kieran?
Well, I would say when we're out speaking with advisors, one of the most frequent topics of discussion is where are the fundamentals going from here, right? And when I speak fundamentals, we often go back to what probably matters most in the long run in terms of where the market's going, and that's earnings, right? So we've been in what we're calling an earnings recession now for 3 quarters. I guess we're not technically done with Q3 earnings. The good news is those Q3 earnings seemed to have troughed, and we're now hopefully heading back the other way. But the concern here is going forward, where are the earnings going to come from, especially at these valuation levels? Unless we get some earnings, the valuation levels of the market in many parts of the market begin to feel a little bit stretched, at least from historical perspective. So what we've been telling our investors is look at that quality sleeve. If you look at where some of the best and highest quality stocks in the market have done with their earnings, they've consistently been more resilient than the broad levels of the S&P 500, which have been dominated not just by tech names this year, but even going back to last year from an earnings perspective. If you take energy, for example, out of the pie, you have a much worse perspective. So the market's been a little bit concentrated, not just in its performance and in its returns, but where those earnings are coming from. We found that higher quality companies have been a lot more resilient. The bonus here is that, again, from a valuation perspective, they look screamingly more appealing to us. Our industry is funny, of course, for a lot of reasons. One of the most obvious ones is when things go on sale, right? We're probably the only industry where consumers run from the sales. If an iPhone goes on sale or a consumer good goes on sale, people run to it, line up for it. In our business, when strategies go on sale or segments of the market go on sale, people tend to flee the boat. That's the time, obviously, not to state the obvious, when those opportunities are the best. So what I would say is look for high quality companies that can deliver earnings resilience, and you're often going to find those at better valuations than the broad market.
Yeah, I think we're maybe, if we're going to do the baseball reference, in the third inning of this ball game. I think that there's a lot more to play out. Look, you're seeing auto delinquencies go up. You're seeing there's a whole bunch of underlying things here, and I think the U.S. I'll agree. The U.S. market, I think, is pretty fully priced. Although if you look sort of underneath the surface of the Mag 7, it's not outrageous. I was talking with a pretty prominent private equity guy and was asking him about it. He's just like, you want to be as high up in the capital stack as you possibly can. And this is this is one of the biggest players in the game. So I'd love to sort of think we declared, we're sort of through this, but I'm sorry to be the doom and gloom guy in the room, because I am a former bond trader, so that's kind of my business. Or my training, but I still think that all of the things that you went through in terms of quality, and if you want to go the Warren Buffett thing of when the sea goes out, you see who's really wearing swimwear. I just think we're in the early innings of that. You don't go, spending trillions of dollars and bringing future gains into the present and not pay a price for that. And I don't think we've fully paid for that yet. So we'll see how that plays out.
So everyone's talking about AI being a huge part of our economy and being even more disruptive than the internet. Are each of you, using AI in your investment decision-making processes yet? And how do you see that playing out in 2024?
I use a magic 8-ball. It's brilliant AI.
We don't. Someone asked us about it, and my answer was, why do I need to be artificially intelligent? You've been pretty happy with my natural stupidity for a number of years, and it seems to work. Certainly, I think there's an opportunity in high-frequency strategies and things that have always been on the bleeding edge, but I think many of the items benefit from a certain sense of slowness and just stability that AI inherently today doesn't try to deliver, at least not the successful models. But I suspect I'm probably alone in sort of holding off on letting AI take over the shop yet.
So I'm 54. I don't understand it, but there's a guy named Larry Connors who's one of the most successful traders who've been around for a long time. And he's someone I know pretty well, and he's out there now talking a lot about how you can take a trading strategy, run it through ChatGPT, I think 4, I guess there's a version 4, and what it can do as far as, telling you, hey, that's a great strategy, hey, that's stupid, improve it this way, improve it that way. So, and he showed me a demo of it, and I was blown away. So I do think it's something that, I've got to take a look at because it's the future. From an investment standpoint, one other thing we're doing, we created an AI index that excludes Fang and Friends. Because, all the other AI investments you see out there, it's basically Fang and Friends, and you don't need another way to do that. So we're going to 2X that too for the retail guys, and we'll get options on it. And yeah, I think that'll be a lot of fun to trade when that comes out. But I think given what I saw, what it can do, I think if you are investing money, you need to be looking at it.
You need to be looking at it, but I haven't heard anybody bring up the point that as these AI systems get better and better, and they compete against one another, profits start to get driven to zero in that environment if you have perfect information, right? So we're hopefully, knock on wood, we're a ways from that. I get all AI, machine learning, are we talking machine learning, are we talking, deep learning, all that stuff. It has moved so fast in the last 3 to 5 years that people generally haven't been able to keep up with just the terminology and the technology of what's going on. It's going to go to the biggest players should be able to exploit it. They're already implementing stuff right now, whether it's at all the big shops are doing the deep dive on it, and we'll see where this comes out. But there's again, not to be the doom and gloom guy, but the better the information gets and the more perfect markets trade, the closer you get to zero arbitrage profits.
At ProShares, we run rules-based strategies, so we do not currently deploy any artificial intelligence in our strategies. You can think of rules-based strategies as following a cookbook, right? So there's elements of active, there's elements of passive in those strategies. Most importantly, what we tell our investors is you're going to know what we own in our portfolios at all times. And I think that is a concept and an idea that will endure regardless of whatever impact artificial intelligence may have on improving our efficiency or however else it impacts the state of running money.
Great. So I wanted to give folks in the audience an opportunity to ask questions. Otherwise, I'll ask another question. Anyone? No? All right, so maybe we do a speed round of this is the best ideas panel, so one more best idea from each of you.
Vietnam, not in my book. I think it's going to accrue all the benefits from, or a lot of benefits from China, or the move away from China.
If interest rates are going to be coming down and the dollar is going to be coming down, buy gold miners and silver miners when nobody wants them and sell them when everybody does.
Yeah, I got to stick with the theme. Bonds.
I'll close it out by saying mid-cap stocks that grow their dividends, trading at somewhere around 60 cents on the dollar with a whole lot of earnings upside from here.
Fantastic. Well, thank you, everyone. Thank you.